You're listening to Investor Insights Decoded, the podcast where our hosts, Michael Grant and Julia Foster, break down the most impactful memos from the world of investing. Today, we'll be exploring Howard Marks's memo, Risk in Today's Markets, written on 17th of February 1994. Let's dive into the timeless insights that continue to influence investors today. Welcome to the deep dive. Today, we're really going to dig into this memo from Howard Marks, the investing legend. It was written way back in 1994.
1994. People hearing that are probably like, come on, is that really relevant now? But trust me on this memo. It's like that fine wine, right? It's aged like a dream. It's got all these insights on risk that are, well, they're shockingly relevant to what we're seeing in the markets right now, even today.
Okay, so bring us back to 94. Marks starts by setting the scene right. Low interest rates got investors champing at the bit for those big games. They're practically tripping over themselves to take on more risk just to get a taste. He calls it a food chain of investors. I love that. Each one tempted to climb to that next level. Riskier, of course, all for a shot at, juicier returns. That image really stuck with me. Expert, am I the only one? Are we seeing this playing out in today's market?
Oh, 100%. That analogy, it's spot on because it really highlights that, almost like a primal instinct that seems to drive how the markets behave. Just think about it. When interest rates are low, investors, they're sitting on cash, and it feels like inflation is eating away at their money. They need a way to make that money grow, and that pushes them toward, what else? Riskier assets. It's almost like a game of musical chairs. Nobody wants to be the one left standing when the music stops.
So who's climbing that risk ladder today? What's that look like now? Is it really that different from 94?
Well, back then you saw a ton of movement, money market funds into bonds, bonds into equities, and don't forget that surge of interest in emerging markets. These days you can definitely see echoes of that, but with, a modern spin on things.
Okay, I'm thinking.
Think about that whole craze with crypto and meme stocks just a couple of years ago.
Yeah.
Textbook example of investors, and a lot of them were totally new to the game, just piling into those speculative assets, hoping to strike it rich, quick.
Which reminds me, Mark's point about hedge funds exploding back in 94. Investors were throwing money at anything, and oftentimes they didn't actually know what they were getting into. He's careful to mention those big, impressive returns.
Yikes.
They come with the potential for equally big losses. So how does the average investor today actually apply that to today's, investment landscape?
That is the million-dollar question, isn't it? Look, it's human nature. We see high returns and we're drawn to them. But we have to remember, risk and reward, they're two sides of the same coin. Whether it's crypto or meme stocks or really any investment, you have to stop and ask yourself, how much am I really willing to lose? Because the higher the reward potential, the higher the potential is for you to lose, everything. There's no such thing as a free lunch, right? Especially in investing.
It's all about knowing your own risk tolerance, right? How much volatility can you handle before you start making emotional decisions? Speaking of risk and making those decisions, Marks drops two of his most famous investing sayings in this memo. This first one really made me think. The less prudence with which others conduct their affairs, the greater the prudence with which we should conduct our own affairs. That's a mouthful. So for someone listening, trying to wrap their head around today's market, what does that actually mean?
It's actually brilliant. It gets at the heart of contrarian thinking, which you see a lot in Marx's philosophy. Basically, he's saying when you see people acting recklessly, throwing caution to the wind, it's a sign. You need to be even more careful, more diligent in how you're approaching things. It's about recognizing those times when the market gets euphoric and not getting swept up in the frenzy.
How can people listening tell when others are being, imprudent? What are some signs to watch out for?
That's where things get really interesting. It's about recognizing those moments when valuations get detached from the fundamentals, when prices are being driven by speculation and hype more than anything with actual value.
So we're talking like those times when everyone feels invincible, like the market's on this rocket ship only going up.
Exactly. Think back to the dot-com bubble, late 90s, or how about that housing bubble in the mid-2000s?
Oh, yeah.
Classic examples of, and Marx might say this, irrational exuberance. People were buying up internet stocks, no earnings to speak of, or houses they couldn't afford. But hey, prices kept climbing, so why not? Nobody wants to miss out, right? But And you know what's coming. What happened?
It all came crashing down.
Crash. The wise man, the
Yeah.
one who saw that bubble early, they took their profits, maybe sat it out completely, and they avoided those devastating losses when it all went, well,
It's a good reminder that history might not repeat, but it sure does rhyme. So when you see those signs, that excess, what do? Just head for the hills, sit on the cash.
Not necessarily. Remember, Marx isn't saying run away from risk. He's all about risk awareness. It's not about ditching the market entirely, but getting picky, discerning about where you put your money.
Being choosy, making your investments count.
Right.
So instead of hopping on the bandwagon, you're looking for those places where the potential payoff actually lines up with, the risks.
Exactly. And that brings us to Marx's second gem. What the wise man does in the beginning, the fool does in the end. This one gets at those market cycles, the ups and downs, and why timing matters. The wise man, in this case, is the one who sees those shifts coming, the one buying when everyone else is panicking and selling when everyone else is on that high.
That sounds a whole lot easier said than done. I mean, how can anyone listening actually avoid being, the fool when it comes to these cycles? We don't have a crystal ball.
You're right, no crystal ball. It's about recognizing patterns, though. Understanding what drives them and being patient. Like Marx points out back in '94, low interest rates, they were already inflating asset prices. Not quite bubble territory yet, but definitely not cheap either. What that means is investors are taking on more risk for, potentially less reward. Sound familiar at all?
Yeah, kind of sounds like what we've got going on now. So anyone listening, how do they figure out that risk versus reward situation? Red flags, anything they should be watching out for?
Time to put on your detective hat. One big red flag, excessive leverage. When people are borrowing like crazy to invest, it's a multiplier. Gains look great, but losses, amplified, increases that chance of a sharp and probably painful downturn. Another one, valuations totally off base from, the actual fundamentals. Could be stocks, bonds, even those alternative investments everyone's talking about.
So if you're looking and you see those price to earnings ratios way higher than usual, or bond yields so low they don't seem real, those are warning signs.
Ding, 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 we got a winner. But it's more than numbers. Pay attention to the sentiment, how people are feeling, that whole market psychology thing. When everybody and their cousin is super bullish, brushing off any risk, that's often a sign. Complacency set in, and a correction, it might be lurking right around the corner. Remember what the wise man does.
The fool does in the end.
Yeah.
Got it. Starting to sink in. But Marx wasn't saying don't invest back then, was he? It was about finding those spots where the potential reward was still, worth it.
Exactly. He was all about thorough analysis, specialization, and not risking it all for a quick win. These are like the evergreen principles of investing. They don't go out of style, just as relevant today as they were back in '94.
So someone listening, maybe they're just starting out. How do they put these ideas into action? What can they actually do?
Number one, don't be afraid to ask questions. Educate yourself. There are so many resources out there now, no matter your experience level. Learn about different asset classes, investment strategies, and how to manage risk. It's all out there.
Just like anything else,
Yeah.
right? The more you know, the better equipped you are to make good decisions.
Bingo! And remember, this is a marathon, not a sprint. Building a diversified portfolio that actually fits your goals, your risk tolerance, your time frame, that's the key. Don't get caught up in the hype, chasing the next big thing.
Patience, discipline, those are key.
100%.
And speaking of discipline, Marx was all about focusing on what you can control, which gets us to inefficient markets. What do you mean by that, and how does it fit into his whole philosophy?
Great question. When he talks about inefficient markets, he's talking about those areas where information isn't flowing freely, where the herd mentality hasn't completely taken over. These are the places where, with the right knowledge and some real digging, you can potentially find those hidden gems, the undervalued assets.
So it's about finding those diamonds in the rough that the rest of the market hasn't caught on to yet.
You got it. He points to high-yield bonds, convertibles, distressed debt, stuff like that. These are areas that need specialized knowledge, a really disciplined approach, but they can offer some sweet returns, especially if you're being smart managing that risk.
Okay, break those down for us a little.
Mm-hmm.
What exactly are those, and why would anyone want to invest in something called distressed debt? Sounds a little scary.
It might sound scary, but that's usually where the good stuff is. High-yield bonds, those are basically bonds issued by companies that, their credit rating isn't the best. Higher risk of default, but they pay higher interest rates to make up for it.
So it's about balancing that risk with the reward potential.
You got it. Now, convertibles, those are a little more complex. Think of them as bonds or preferred stock that can be converted into a set number of common shares of the company. So, potential upside if the stock takes off, but you also have some protection if it tanks.
And distressed debt. That sounds like you're wading into the danger zone.
It can be, but it can also be pretty lucrative if you know what you're doing. Distressed debt. It's the bonds or loans of companies in a tough spot, maybe facing bankruptcy, restructuring, something like that. These things often trade at a big discount because, well, people are worried about the risk. But if the company turns things around or that debt gets restructured in a good way, investors who got in early at those discount prices, they can make out like bandits.
That's wild. But it sounds like you really need to know your stuff.
No doubt. And that's where Mark's thing about specialization comes in. He was big on sticking to what you know or what you're willing to really learn inside and out. That's a takeaway for any investor, no matter where you're at. It's easy to get distracted, chase the latest trend, but the real wins, the long-term success, that often comes from becoming an expert in a particular area.
So instead of being a jack of all trades, you're saying become a master of one.
Exactly. Focus your energy. Become an expert in a specific niche. Could be tech stocks, real estate, distressed debt, whatever gets you fired up.
You're making me rethink my own strategy here. I've definitely been guilty of jumping on whatever the hot stock tip of the day is.
Yeah.
What I'm hearing, though, is it's more about playing the long game, doing your research, being disciplined.
You got it. Investing isn't just about picking stocks. It's about understanding those forces that drive the markets, making smart, informed decisions that'll help you reach your goals over time.
And that ties into another thing Marx talked about that really hit home for me. Capital preservation. He wasn't about swinging for the fences on every investment. He knew that protecting your capital, especially when things are uncertain, was like the most important thing. Can you talk about that more?
Absolutely. Capital preservation, it often gets overlooked when people are chasing those high returns, but it's the foundation of good investing. It's about putting the return of your capital ahead of the return on your capital. Understanding that it's way harder to recover from a big loss than it is to make smaller, consistent gains over time.
So it's not just about making money. It's about not losing it in the first place. It's about having a safety net, that cushion, to help you weather those market downturns without blowing up your long-term financial well-being.
Exactly. It's like that saying, it takes a lifetime to build a good reputation, but only a moment to ruin it. When it comes to investing, you can spend years building a solid portfolio, but a handful of bad decisions can wipe it all out. That's why Marx was so big on thorough analysis, on really understanding the risks before you jump in, not just chasing returns. He was a big fan of sticking to senior securities.
Now, when you say senior securities, what does that mean? How does that play into this whole capital preservation idea?
When he talks about senior securities, he's talking about investments that have a higher claim on a company's assets if things go south, like bankruptcy or liquidation. Think of it as like a pecking order for creditors.
So bonds over stocks in this case.
You got it. Bonds usually offer more protection than stocks because bondholders, they get paid first if a company goes belly up.
So it's a way to manage risk, to prioritize getting your initial investment back safe and sound.
Exactly. It's more conservative, but it fits with Mark's whole philosophy of preserving capital, minimizing those big permanent losses.
This is all making a lot more sense now. Thorough analysis, specialization, capital preservation, sticking to your guns, and being aware of risk, not afraid of it. These aren't just, catchy phrases. They're core principles to guide you through those market ups and downs.
And what's really interesting is that even though he was writing this back in '94, totally different economic climate, those principles, they haven't aged a bit. They're just as important, if not more so, in today's market. We're seeing the same trends, that same reach for yield, sometimes at the expense of managing risk.
It's like that saying, history might not repeat, but it often rhymes, especially in the markets.
You said it. And that's why this memo is such a great read for any investor. It's a good reminder that the fundamentals of smart investing, they don't really change, even as the markets do their thing.
It's about focusing on what you can control: your process, your research, your own risk tolerance, tuning out the noise and sticking to those principles, even when it's tough.
It's about remembering that investing is a long game. Slow and steady wins the race.
It really is something. How much of what he said back then still applies now?
It's a testament to how he approached investing. It wasn't about chasing the next hot stock or trying to time the market perfectly. He was all about understanding the fundamentals of value, risk, how markets work, the whole picture.
Like he had this sixth sense, this ability to cut through all the noise and see what was really going on.
Absolutely. And that's a skill any investor can develop. Doesn't matter if you're managing millions or just starting out. It's easy to get caught up in the day-to-day, but it's the long view that matters.
Playing the long game, being patient, not letting your emotions run wild.
Exactly. And that's something else Marx was big on: emotional discipline. He knew that investing is as much about managing your feelings as it is managing your money.
So how do you actually do that? It's easy to say don't panic when the market takes a dive, but it's harder to actually stay calm when you see your portfolio shrinking.
Oh, it's definitely not easy, but it's crucial if you want to be successful in the long run. One of the best things you can do is have a plan. A real solid investment plan, one that matches your goals, your risk tolerance, how long you plan to be in the game. And then, here's the hard part: stick to it, even when things get rocky.
It's like having the guts to stay the course, even when everyone else is jumping ship.
Exactly. And that's where really understanding your investments comes in. If you've done your research, you truly believe in those companies, those assets, you're less likely to do something rash just because the market is having a bad day.
It's about filtering out the noise and focusing on the important stuff.
Love that analogy. It's about the fundamentals, the underlying value, not getting caught up in every little headline or rumor. And remember, sometimes the best moves are the ones you don't make. It's fine to sit back, be patient, wait for those prime opportunities where you have the edge.
Be disciplined, do your research, and trust your instincts.
Couldn't have said it better myself, and I think that's a great place to wrap up. Mark's memo is full of wisdom, but if there's one big takeaway, it's this: investing. It's a journey, not a finish line. You're always learning, adapting, getting better, and most importantly, enjoy the ride.
That's something to think about. Until next time on The Deep Dive.